We've got an F581 question again here. An indirect, discuss the extent to which indirect taxation would be effective in reducing market failure. We've got a definition here: an indirect tax is a tax on spending which is paid to the government. An example is indirect tax is air passenger duty. So we've got AO1, AO2 there. Taxation is effective in reducing as it increases production costs to the business, which they're less willing to supply goods. In this case, flights, application, at a given price. Don't need the word level, just given price. They do this because the average costs increase in order to maintain profits. Supply of the flights decreases from S to S1. This has the effect of increasing the price of flights P to P1, meaning the original low price falls and consumers will be less willing to purchase flights, which leads. I think we have to get away from thinking of flights causing congestion to flights causing pollution. That's the main negative externality, air pollution, due to the high percentage of income being taken up before with the tax. Better way to say that is the reduced utility. This decreases the quantity demanded of flights from Q to Q1, which in turn prevents the quantity demanded of, or in turn prevents overconsumption of flights, which therefore means the level of negative externalities falls. The social costs are now the same level as the private costs. The entire external costs are paid by the first party, and therefore this means that the third party don't have to pay higher taxes. Health from pollution. This increases allocated efficiency of the market as consumers have increased disposable income, which can be spent on goods and services. Their value increasing utility. Well drawn graph, well analysed. I think the only thing I would maybe add is the welfare loss, and that's the socially optimum quantity, and then maybe something here about reaching social optimum. But excellent analysis of how a tax would work. However, tax may not be the most effective solution to decrease market failures due to inelastic demand. We've got a point against, where demand is unresponsive to changes in price. Definition. This is highlighted in the graph where the demand is inelastic, which means the tax being added results in a large price increase, which produces only a marginal decrease in quantity demanded. So we've got some AO3, we've used the graph, and as we've got a point against, we've got AO4 as well. This inelastic demand may due to occur to a lack of substitutes such as trains. Some good application to the market. The level of congestion and air pollution remains high, so market failure remains. In order to make the tax more effective, a subsidy could be implemented on substitutes in order to increase the availability of trains, for example. AO4 point level 1. Supply of trains will increase from S to S1 as providers are more able to okay. What we've got here is now talking about how a subsidy works, not why a subsidy makes a tax more effective. So we've turned this into a subsidy question rather than evaluating the tax. And we've got the subsidy graph here, but again, not answering the specific question. Again, there is a judgment here. Tax is the most effective method, but it's not backed up. And this again is AO3 not answering the question. What we need to do to use that subsidy argument is link the subsidy into increasing the elasticities in terms of price and XED. And then this causes the tax to be more effective. You could potentially talk about how linking it to information provision would have a similar effect, or you could compare it to regulation in that can be quicker and also have a more specific effect on quantity rather than just price.